So welcome to TradingHD, and for some of you who've been here before, you're probably familiar with these first few slides that we'll very quickly run through. My name is Ashwani Mathur. I run a brokerage business in London. We speak to some of the biggest hedge funds globally, and we talk to them about all asset markets, including global macro, and then single stocks and sectors, and where clients should be long and short. So let's dig into the presentation. Just before we begin, I have a very quick disclaimer and risk disclosure to go through. The information contained within this presentation is intended for educational and illustrative purposes only. It does not constitute investment advice. Do not make any investment decisions or other decisions based on the material presented. We cannot be held responsible for your trading results. For more information, please visit www.tradinghd.com. That's a little bit about myself. Like I said, been covering hedge funds for many years. I deal in all global equity markets, looking at multiple stocks within the S&P, within the Nasdaq, within Europe, and also within emerging markets in Japan. So here's something Lex Van Dam has said about my approach. He's someone I've known very well over the years. So for some of you, you've seen the slide before. It's just nice to have Lex endorse our work. Okay, so I think you guys must be all very interested in seeing what's going on. So we pick up exactly from where we left in the last webinar. And if you recall, I had very clearly mentioned to everybody that the RSI of the S&P on the monthly chart was bumping against 60. And which made it a very uncomfortable position to put out any kind of short. And if the RSI took out 60 on the monthly time scale, that could qualify as a big breakout in the S&P. And as you can see, this is the live picture as of 28th of July, and you can see that the S&P has broken out of this line of resistance. As you can very clearly see, the RSI accompanying the breakout has taken the RSI to 63. So all our long should have been activated some time back. And we look at the next slide, which is to actually look at the breakout on the weekly chart. And this is a chart that you guys must be all familiar with because I've shown this in every single webinar since last October, where from 2015 through to 2016, for this entire 1 year, the RSI repeatedly failed at a level of 60. All these levels of 60 were excellent levels to sell into resistance. This time around, something very interesting has happened. The RSI of the S&P has taken out the weekly resistance level of 60 for the first time in almost 1.5 years. You can see the RSI is at 63. This also coincides with the price breakout, which you can see is a new high on the S&P. So actually, contrary to a lot of the opinion in the marketplace where people seem to be very confused, actually it's a picture of remarkable clarity. And the picture of remarkable clarity is that we have had a very clean breakout on the monthly chart and a very clean breakout on the weekly chart. And now it is actually very simple. You stay long on the S&P till such time that the weekly RSI shows any signs of failure and closes below 60. Now, if this is a very strong breakout, this little pullback that we are seeing should be nothing other than just a short-term pullback, and the S&P should carry on again. In my opinion, we have taken 60 out on the weekly after a long ranging period, so you have to be bullish on this breakout. But what's really critical to understand is that this is a breakout at the index level. There's a lot of stuff within the S&P that is not yet breaking out. So you still have to buy the S&P, you have to stay long. You've got to be very careful if this weekly RSI closes back beneath 60. We could qualify as a false breakout. It's too early in the breakout to label this as a clean breakout. To be a clean breakout, we need this pullback to hold and for the market to start to climb again. And if we start to climb again from here on the weekly time scale, and let's say in like 3 weeks time or so we are at 2200, we've qualified the higher lows, we've qualified the breakout, we've qualified the breakout of 60, we have a trend. So the next couple of weeks are actually extremely critical for the market to hold this breakout and stay above it. And this is something you can monitor in real time using the RSI on the daily chart. Use the same logic. If the RSI of the S&P, which is above 60 on the weekly and the monthly and the daily chart, stays above 60, you have to stay bullish. If the daily RSI ever closes below 60, that is the first time that you start to say, okay, maybe this could be a false breakout of the S&P. Not until then. This is the other chart of the Nasdaq, and you can see that the Nasdaq has taken long-term resistance from the 2000 peak, spent almost 1.5 years going sideways at that peak, corrected a very overbought RSI situation, and now has a monthly RSI reading of 61.3. Now, 61 is way too close for 60, way too close to 60 for me to say that this is now a confirmed breakout and we are in a confirmed trending phase for the market. You can see there's this wonderful looking trend line that comes in from the lows. We need to penetrate above this trend line, and then we need to hold above this RSI of 60. So, the conclusion, it's bullish. Everything is unequivocally bullish in the US equity market. But it is way too early for us to qualify this as a confirmed breakout. So as traders and as good market watchers, be careful with the RSIs closing beneath 60. As long as they trade above 60, you stay long and strong. So here is the same weekly chart of the Nasdaq. But what's really interesting is, and it's really caught my attention in the last couple of weeks, is that despite the S&P making new highs, the Nasdaq has actually not yet made a new high. Even though we have a confirmed breakout on the weekly RSI, the fact that the price hasn't yet broken to a new high is still a red flag. So again, be careful over the next couple of weeks. If we are able to break above here, we will start a beautiful trend. But if we fail here, you've got to be careful if the RSI start to close beneath 60. This could still yet qualify as a false breakout. Here is something which is giving me a lot of confidence that we have to play the bullish side of the market. And this is the SOX index, which has very convincingly broken above 60 this time. And as you can see, over the last 15 years, this was the only other occasion that we actually went through 60 properly. You can see multiple failures for almost 12 years at an RSI reading of 60. And once we took this RSI reading out, we created a beautiful uptrend in the semiconductor space. What does this mean? This means that the demand for technology is not going away. The demand for chips is not going away. And that itself is a bullish signal for the entire market related to technology. If the semiconductor stocks are acting well, you have to stay bullish. So very clean breakout on the SOX index. Very clean bullish phase. You've got to stay long. Now here is something which is, so you saw the SOX index, which arguably is one of the strongest indices in the US market right now. But what's a slight concern for me is that the US transports relative chart to the S&P is nowhere near as bullish as the S&P itself, which means that perhaps the real economy stocks are still going to underperform within the S&P, and most of the money is still going to be made by owning things related to tech.